India is disappointing everyone, and investors are leaning in anyway. That contradiction is the story. On one hand, you hear it plainly, India has been a laggard. Growth didn't show up the way markets expected. Capital investment didn't surge. The year felt, in the words used on camera, deflated. And yet some of the longest tenured emerging market investors aren't backing away. They're doubling down. One of them says he's been an India bull for 20 or 25 years, even while admitting India has always been expensive and, quote, gets in its own way. Here's why that matters to you. If India really is stuck, bureaucracy, weak starts, currency pressure, then optimism here is dangerous. But if this is one of those moments when sentiment breaks before momentum returns, then waiting could be the real risk. Notice what's already embedded in that tension. Disappointment is visible. Optimism hasn't left, and historically those two don't coexist for long. But here's the part nobody is saying out loud yet. This isn't about last year's numbers at all. To understand what's happening, you have to zoom out before you zoom in. The core event here isn't a crash or a boom, it's a pause. India didn't get off to a very, very good start. That's stated clearly. Growth came in below expectations. Capital expenditure didn't materialize the way markets hoped. Foreign funds exited largely tied to what's described as a currency issue, with the rupee among the weakest performers in the Asia-Pacific region. Investors expected more growth and more investment last year, and they didn't get it. But this isn't being framed as a one-off miss. It's being framed as part of a recurring cycle. The speaker points out that over the last 20-25 years, there have only been 4 different times when people weren't very positive on India. And each time, getting in during that pessimism led to strong performance in the following years. Notice the reframing. The question isn't why is India struggling? It's why does skepticism keep showing up right before rebounds? And here's the cognitive pivot. If strategists aren't really enthusiastic about India right now, is that a warning or a signal? Because if this moment fits the pattern, the real story hasn't started yet. The claim being made here is subtle but strong. India's weakness may actually be its setup. The investor says India has always been expensive, and yet he's still overweight India personally. That's not casual language. Expensive markets don't usually attract long-term overweights unless something else is compensating for the price. In this case, the compensation is inefficiency. He calls India a market where stock pickers can outperform. That matters. In his words, this is no longer true in places like the United States where markets are highly efficient. But India, he argues, still leaves room for investors willing to do the work and really make picks. Here's the concrete detail that anchors this. He says he would be a selective buyer of some industries and companies, not backing away from the market, not going all in indiscriminately, but leaning into specific pockets. When capital leaves broadly but specialists stay selectively, it suggests mispricing rather than decay. Now notice what's missing. There's no claim of a near-term boom, no promise of instant upside. In fact, he explicitly says they're not looking for a real strong year. That restraint is the tell. This isn't hype-driven optimism, it's positioning. And here's where the story flips. If India doesn't need a great year to outperform, what exactly does it need? What changes next is not sentiment but pressure. India is described as having lots of problems, with bureaucracy slowing down the economy in many, many ways. That's not a throwaway line, it's an admission that friction is still embedded in the system. And yet alongside that, there's a second fact moving in the opposite direction. Growth is still running at 6-7%, not theoretical growth. Actual growth happening while those bottlenecks still exist. That combination is unusual. Historically, when economies normalize inefficiency, they stagnate. Here, inefficiency is being tolerated because momentum hasn't collapsed. But this is where escalation begins. The speaker points directly to government action. He says Modi is taking measures to curb the bureaucracy and to try to open up the economy more and more. That's the inflection. Not reform already completed, but reform in motion. This mirrors something investors have seen before. Early stage China wasn't efficient either. Growth came first, cleanup came later, and once cleanup started, capital followed fast. Here's why that detail changes everything. If India is already growing with friction, then even modest improvement multiplies impact. Normalization hasn't happened yet, but momentum is starting to test the system, and when systems get tested, they either break or accelerate. Now the evidence sharpens and it gets harder to ignore. The investor isn't just talking about public equities. He explicitly points to opportunities even in fixed income in India, and more notably, private debt in India has a lot of opportunities with a huge spread there. That's not language used when risk is evenly priced. Large spreads exist when capital is scarce, cautious, or misallocated. At the same time, there's a contradiction on the surface. Foreign funds are exiting, the rupee is weak, strategists are cautious, yet privately, capital is finding ways in. He says he wouldn't be really underweight India in an emerging markets portfolio and would be at least equal weighted, if not overweighted. Public sentiment and private positioning are diverging. Now notice what they're not saying. There's no denial of the risks. Currency pressure is acknowledged. Bureaucracy is acknowledged. Even disappointment last year is acknowledged. What's missing is panic. There's no urgency to escape. And this is the line that permanently reframes the issue. It's times like this that historically delivered strong performance. That's not hindsight talking, that's pattern recognition. When exits are happening for surface level reasons, but deeper capital is widening exposure across debt, private markets, and selective equities, the market isn't being abandoned. It's being reorganized. And reorganizations don't stay quiet for long. Then the story compresses. Multiple pressures hit at once. Fiscal stimulus has been limited. The government has been hesitant to do a lot of fiscal stimulus, even as growth underperforms expectations. At the same time, there's acknowledgement that it probably needs to do a bit more and be more friendly towards capital investment. That's one pressure point. AI is absorbing global attention, but the speaker says that over the next year or two, there will be a real surge for opportunities outside of AI. That's a second pressure point, redirecting capital flows. India has huge infrastructure needs and huge growth potential, positioning it as a diversifier investment opportunity, just as global investors look to rebalance. These aren't isolated developments, they're stacking. Policy hesitation, capital rotation, infrastructure demand, each one alone is manageable. Together they accelerate decision-making. This is where speed matters. Once capital starts moving away from crowded AI trades, it won't wait for perfect conditions. It will look for scale, population, and absorptive capacity. India checks those boxes, even with friction. So here's the question that hangs in the air. What happens if this continues? If pressure builds faster than policy responds? Now shift the frame, because this isn't abstract anymore. This lands on people. India has 3 billion people, and most of them below the age of 30. That's not just a statistic. That's a consumer base entering its spending years at scale. Urbanization is increasing. Consumer spending is identified as number one in driving future returns. When growth pauses in a country like that, the delay isn't neutral. It affects jobs, wages, housing, and cost of living in real time. Employment in electronics is expected to increase very rapidly. Manufacturing is expanding from assembly into more sophisticated components. Software work tied to chips is already being done in India today. So if you live there or depend on its growth indirectly, this isn't about market timing. It's about whether opportunity expands fast enough to absorb a young population, whether investment keeps pace with ambition, whether reforms translate into paychecks, remove ideology, and this becomes simple. Growth that's too slow creates pressure. Growth that accelerates creates relief. If this feels familiar, waiting for momentum that's promised but delayed, Say so in the comments, because the real tension isn't optimism versus pessimism. It's time, and the clock is still running. This is where the mechanism becomes visible, and it's quieter than headlines make it. India is described as an open economy, with states competing with each other. It has an English-speaking elite group of people, very well educated, capable of absorbing technology from around the world. You see it, as said on camera, with Indians training in every direction and doing a lot of tech work. That combination matters more than any single policy. Open systems don't need perfect coordination, they rely on competition, absorption, and scale. When capital enters, it doesn't wait for permission from one center. It finds the fastest path. This is why inefficiency hasn't broken India's growth. The system leaks, but it also self-corrects. Contrast that with closed systems, where mistakes compound. Here, pressure redistributes. States compete, firms adapt, talent moves. This is the unsettling insight. India doesn't need everything to go right. It just needs enough incentives aligned at the same time. Consumer demand, manufacturing transfer from China, software leverage, capital looking for diversification. Mainstream coverage focuses on what's holding India back. This lens shows what keeps pulling it forward anyway. And once those forces synchronize, control shifts away from planners and toward momentum. Now the story moves forward, and it splits into two paths. There are real headwinds. The rupee is weak. Trade uncertainty exists. The Trump-Modi relationship is described as looking bad, at least on the surface. But the response is revealing. It's called purely bargaining, a cat-and-mouse game, with the assertion that trade between India and the US will do very well, and even trade with China continuing alongside that. Short-term political tension isn't the driver here. Negotiation noise is. At the same time, manufacturing is already shifting. There's explicit mention of production being transferred from China to India, particularly in consumer electronics, much of it destined for the US market. That's not speculative, it's happening. So the paths are clear. One path is delay. Bureaucracy lingers. Fiscal stimulus stays cautious. Growth continues, but below potential. The other path is acceleration. Modest stimulus. Capital investment becomes easier. Manufacturing deepens upstream. Neither path requires perfection, but only one compounds. And here's the quiet implication. The next move won't be announced. It will show up first in hiring, production lines, and capital flows. By the time markets agree on which path India's on, positioning will already be crowded. There's one insight that ties all of this together. India isn't being priced on what it is. It's being priced on how long it takes. The investor never denies the problems. Bureaucracy exists. Currency pressure exists. Disappointment happened. And still he talks about 12 to 15% returns over time, driven by consumer demand, technology absorption, manufacturing, and scale. Not overnight, over years. Reframe the story in one sentence and it clicks. India is a market where frustration arrives early, but payoff arrives late, and most people leave in between. That's why this moment matters. Not because everything looks good, but because enthusiasm is low while positioning is quietly building. Because the question isn't whether India grows, but whether patience runs out before momentum shows up. The next chapter won't be about whether India is exciting. It will be about whether it's already moved. And that's the layer we'll break down next, where the earliest signals actually appear before headlines catch up. If you want that analysis when it drops, follow and subscribe.